This is the Best Stocks to Buy podcast. Looking for quality stock tips? Well, we bring you timely investment ideas based on the latest stock and market outlooks. Our ideas are driven by a proprietary software that reviews, analyzes, and ranks over 6,000 stocks every week. So you may hear the name of a company you haven't heard of before. And you know what? That is often the best kind of opportunity. An opportunity to get in early before the investing masses. The Best Stocks to Buy podcast is made possible by Kind Management Group, a registered investment management firm serving individuals, business owners, and family offices. Hi everyone, this is Mathis Connor with Kind Management Group, and this is the Best Stocks to Buy podcast. Today is Saturday, December 3rd, 2016, and this week we're going to be looking at the best dividend stock to buy right now. And here on the opening slide, it's titled The Setup and the Approach. And the key objective of this podcast is to find and present a high probability upside potential stock. And now the key tool we use is a financial model, a proprietary tool that we developed that uses multiple valuation approaches across 6,000 stocks every week. Actually, that's over 6,000 stocks. So yes, we're quite pleased with what we've developed, and we hope you find it of value as well. So the view you're getting is not driven by some sensational headlines and popular publications focused on increasing readership, but simply based on the best investment opportunity we could present. An easy way of thinking about our approach is to think about the method of triangulation that law enforcement uses to locate a cell phone. In our case, we use a form of triangulation to locate a future stock price using different valuation methods. Here's a backdrop. Now, the approach we use, we viewed as being pretty daunting to create such a model, but we believe we were well prepared for the challenge. I have over $15 billion of transaction experience and computer programming experience as an engineer as well. And so our approach didn't come to us overnight. I painstakingly reviewed over 40 years of white papers, taking away the best that each had to offer, then added some of my own tested intuition to implement new data sets that weren't even available as little as 10 years ago. Furthermore, my model uses both historical and projected values and takes into account management's historical accuracy of meeting the projections that they share with the public. Now, a point worth remembering, these views are based on today, unforeseen economic report, regional conflict, or revised policy can change these expectations tomorrow. And a benefit of using a professional money manager like Kind Management Group is having someone experienced in making educated assessments about the uncontrollable, as well as having someone readily share their opinion on whether a particular event is reason for concern. And now, so what did our model find for you this week? The best dividend stock to buy right now, we found it to be in the drug industry. And on to the next slide. It's called the industry overview. The drug industry is comprised of a diverse group of companies that serve the world population with a variety of medicines. I mean, no surprise there. Just to level set, we thought I'd present to you the largest competitors in the drug industry, and here they are. Bristol Myers Squibb. Next is GlaxoSmithKline, followed by Eli Lilly, Merck and Company, and Novartis. Those round out the first five. And the next five are Pfizer, Sanofi, AstraZeneca, Novo Nordisk, and Teva Pharmaceuticals. Now, the growth drivers for the drug industry right now are just continued innovation and research and development, an aging population, the Affordable Care Act, and the industry challenges as of late have been congressional challenges based on drug prices. And now, the big reveal. The best dividend stock to buy right now is a company called Novo Nordisk. The ticker symbol is NVO, and we see the 6-month upside potential at 42%. Yes, that's quite a bit, and we'll talk about that shortly. On to the quick facts slide. Here's a business summary description. Novo Nordisk is a major producer of insulin and diabetes care products, as well as treatments for coagulation disorders and hormone replacement therapy products. Their world market share for insulin is 47%, so they have a very large market share. By 2015 sales by region, in the United States, 48%, Europe, 20%, China, 11%, the Pacific, 8%, and the remainder, 13%, is listed as other. So they have a very worldwide footprint. Their website is www.novonordisk.com. Novo Nordisk, just like it sounds, .com. The company is headquartered in Princeton, New Jersey. They were founded in 1981, and they have 41,450 employees. On to the metrics slide. Now, the annual revenue for Novo Nordisk over the last 12 months was $15.8 billion, a sizable firm, and their cash from operations was $6.7 billion. The operating margins for 2016 were 47%, very high, and for 2017 also at 46%. So these are very high operating margins. The trailing PE ratio right now is at 14.7, and the forward PE ratio is at 13.1. That alone should raise your eyebrows in an opportunity, because usually when you have operating margins that high, you don't see PE ratios this low. The PEG ratio stands at 1.8. Usually you want something at around 1 as far as identifying bargains, but we think that this is a strong bargain, as we'll discuss shortly. The price-to-sales ratio is at 5.6. The price-to-book ratio is at 14.4. And the enterprise value to EBITDA ratio stands at 11.3. But as far as a dividend yield, this is a healthy dividend payer. The dividend yield right now stands at 3.2%, and the average dividend payout ratio is at 47%. So that means that usually they pay out 47% of their annual earnings as a dividend. On to the next slide is the price chart for Novo Nordisk. Now, what you'll see is that Novo Nordisk experienced a very strong pullback over the last 3 months, and we believe that this means nothing but opportunity. The stock for the 9 months prior to these three was up, around $60 or so, and now it is in the mid 30s. So there's a reason for that, of course. And basically, there have been recent negative news, and from what we could tell, we simply view it as a market overreaction. On to our next slide. We call it the looking back and looking forward slide. Okay, so looking back. In the last 3 months, Novo Nordisk has experienced a few events that has caused its stock to decline. Number one, the company lost a large U.S. contract for its Novolog insulin drug. So, yes, they lost a large U.S. contract, but as I discussed earlier, this company has a global footprint. The company lost its U.S. exclusivity for its hormone therapy products, some of which are going off patent. And additionally, the company is experiencing increased global competition for its diabetes and pharmaceutical products, and consequently have lowered its projected earnings. So the stock's experienced a pullback from around the $60, $55 range down to around $34 today. And looking back over the last 3 months, yes, they've experienced some negative news, but we believe that this is nothing but opportunity. Now, looking forward, growth is still expected to occur, but just at a more modest rate. The company is also waiting on more than half a dozen regulatory decisions over the next 6 months on its drugs. So they're still clearly doing a lot of R&D. The long-term outlook remains positive, and we just simply view this pullback as a market overreaction. And the projected earnings really suggest this stock is just very inexpensive right now, making it a quality purchase opportunity that is also now paying an above-average dividend. On to the next slide. The why now, the bull rationale. Well, despite the problems that they've had over the last few months, the company is still expected to experience increasing sales and revenues per share. And additionally, the valuation metrics are very low right now. And because earnings are expected to increase, the valuation metrics are expected to be even cheaper in the near future. Additionally, the company is buying back shares, which tends to push the stock price up. So, why are we bullish? Increasing revenues per share, low valuation metrics right now, expected to be lower valuation metrics in the near future, and the company is projecting to buy back its shares. Onto the summary slide. The financial statement quality for Novo Nordisk is excellent, and I mean it is really excellent. They have lots of cash and very little debt. They have about $2.5 billion of cash, and at best maybe $500 million in debt. The operating margin is flat right now, but 47% is very above average and extremely healthy. So the price pattern trend has been declining. As we mentioned, the stocks experienced a severe pullback, but we don't expect the price to stay down that low. And the industry outlook for the drug industry right now, we see it as flat. Basically, there is a lot of innovation. We have an aging population, but in the wake of the recent election and uncertainty around the Affordable Care Act, we just are kind of taking a cautious approach and considering the industry to have a flat outlook. The overall market outlook is improving. GDP over the third quarter of 2016 came in at 2.9%, and it's expected to remain around that level for the next 2 quarters. And coming back to Novo Nordisk, our 6-month price, the recent closing price for Novo Nordisk was $33.55, and our 6-month price target is $47.60. So that's still below its recent highs of just 6 months ago, but that is a significant upside potential, and we see, and that upside potential is right now at positive 42%. So it's for all these reasons that we believe that Novo Nordisk is the best dividend stock to buy right now. We hope you found this presentation helpful, and we'll talk to you again soon. Take care. Bye. Hello, everyone. This broadcast was made by Connor Management Group. We are a registered investment advisor and money manager for individuals, businesses, and family offices. We are not your typical financial advisor in that we invest our clients' funds directly into individual stock positions. We do not put our clients into other stock mutual funds. At Connor Management Group, we help you grow and protect your assets. We craft high-growth investment portfolios for your children and other minors. We manage the rolled over assets from 401k accounts. We manage IRA and trust accounts. So how do we go about serving our clients? One big differentiator is that we develop some pretty comprehensive computer software that reviews, analyzes, and ranks over 6,000 stocks on a weekly basis. And from that, we create concentrated investment portfolios of well-researched and closely watched stocks. Furthermore, we operate under a managed account arrangement, and that means you open and fund a brokerage account in your name, and we simply manage your investments electronically. That gives you, our client, the greatest control and transparency possible. You can learn more about our service at www.connormg, that's CONNERMG.com. Additionally, we've set up a group on the LinkedIn platform. The name of our group is simply called Stock Investing Tips, Better Returns, Bigger Pockets. Now, this is a private group, which means you have to click the Ask to Join link. We do this because we want to be able to control the quality of the member experience. So if you like what you heard and you would like to receive more timely investment information and be able to post questions, just send me a message to ask to join our LinkedIn group. You can readily find my profile on LinkedIn. It's Mathis Conner. That's MATHISCONNER. And if you have any problems connecting, just send me an email at mathis@connermg.com. Well, that's all for now, and I'll talk to you in our next broadcast, or hopefully with you in our LinkedIn group. All right, everyone. Have a great week.